Thank you so very much. It is a great pleasure to be here again today. I always love this, a beautiful facility. I always love the view that we have here from the main dining room. It's a really lovely place to be, so I enjoy it. And I'm very happy to present my housing forecast. As you know, every single year the Center for Real Estate does an annual housing forecast. And I left it at the table here. Let me grab it real quick. At your place, you should see a copy of our Saline County housing outlook. While we don't formally forecast each of the micropolitan areas across the state, we do try to provide a snapshot or an overview of what's going on. And so encourage you to take a look at that and take advantage of it. I'll talk about some of the things in there. And I want to give a special thank you to Credit Union of America. They are the sponsor for the Saline County Housing Outlook, and so it's because of them that we have the nice printed copies that are available for you. And so we're very grateful for the partnership we have with them. And I also have to give a thank you to all of the realtor boards across the state. We have a contract with the Kansas Association of Realtors whereby we have access to every multiple listing service in the state, including those that are associated with the Great Plains Association of Realtors, headquartered here in Salina. And we provide them then with monthly MLS statistical reports, which give very current real-time information on the state of the housing market. And so if you are interested as you go forward through the year of what's going on in the local housing market, I'd encourage you to talk to the Great Plains Association, and they can make those reports available to you. But it's because of that relationship we also have access to the data that allows us to do our annual housing forecast. So we appreciate that partnership. And so when I do our annual housing forecast, I always start with the labor market fundamentals and the mortgage market fundamentals. And this is a slide from the presentation I gave here last year, where I said current fundamentals are really solid. Labor market is strong. The mortgage financing is widely available and cheap. But I gave a caveat because there just felt like there was something that was sort of like, when's something bad going to happen? Because something bad just has to happen. And so I said all of this could change very quickly. I had no concept whatsoever how it would change or how quickly and dramatically it could change. It was absolutely stunning what we've seen. And Jeremy's talked about the labor market situation. And if I had to summarize what I take away from that in terms of how the labor market is impacting or will impact housing markets going forward, so far it's been not much. And I'll show that to you in some slides. But I do have concerns as the recession continues to expand and impact other segments of the economy and other sectors that the impact on the housing market may come forward next year and then going forward. So we'll talk about that as we go forward. The bright spot for housing markets has been the mortgage market. And last year we said, mortgage rates, they're not going to go up, but they're not going to go down any further. It's just not possible. And every time I say something definitive like that, I'm proven wrong once again. So I need to stop saying things, but man, mortgage rates that have dropped below 3% for 30-year fixed mortgage rates. I think some of you have seen you can get 15 and 10-year rates down closer to 2% than 3%. Really stunningly low rates. Mortgage Bankers Association's forecast is that the 30-year fixed mortgage rate will stay below 3.4% through the end of next year. And this is all due to the Federal Reserve, again, ramping up their purchases of mortgage-backed securities, which is really driving down. One of the things that I note on this is that the blue line at the bottom is the 5/1 adjustable rate. That's a mortgage that is fixed for 5 years and then adjusts annually thereafter. And typically there's a spread between the 30-year fixed rate and the 5/1 adjustable rate because mortgage lenders are starting to bear interest rate risk with that adjustable rate. But you'll notice here now, there is absolutely no difference between the 30-year fixed rate and the 5/1 adjustable. And again, that's because of the actions of the Federal Reserve in directly purchasing mortgage-backed securities that are really driving down those interest rates. So, although there's been some tightening of mortgage underwriting standards, it has not been severe at this point. And so mortgage finance is really continuing to add further stimulus to that, what's already a very strong housing market. So what have we been seeing? Well, the blue bars on this are the home sales across the state of Kansas, and you can see the seasonality pattern here. Sales go up in the spring and they go down in the fall and in the winter. And so that orange line is a moving average, which basically just smooths out that seasonality. And what we can see here is that after a number of years of fairly healthy growth in home sales activity, we seem to have plateaued in Kansas, with home sales really kind of flattening off. And that was happening before the pandemic occurred. The reason that home sales have plateaued is not because of a lack of demand. Demand is incredibly strong out there. Instead, as I'll show in a moment, it's due to a lack of inventory. Bear with me, I'm going to grab my water so that I can keep my voice well here, and then I'll resituate my microphone. So, pardon me. Too many clips and things to deal with here. So you might ask, how is that different for Saline County and for the Salina area? And the answer is that, again, that plateauing effect over the last several years has been there, but this year there's actually been an uptick in home sales activity, a pretty healthy uptick in home sales across the Salina area. And so, again, housing market demand is really strong. Matter of fact, one of the things that I say in our full forecast booklets for all of the major markets, by the way, there are copies of those booklets in the back of the room. You're welcome to pick those up. But one of the things that I've said about those is that from looking at the housing market, you wouldn't know that we're in a recession. Realtors are incredibly busy and fielding tons of calls. And the only reason sales are not growing stronger is because of a lack of inventory. Our forecast for home sales across the state of Kansas this year is a slight increase, a 1% increase. Again, that's really reflecting some of the, it would be stronger if it were not for the fact that there aren't enough homes available for sale. We're forecasting a slight decline next year. That's due to two factors. Number one is the tight inventories and simply not, you can't sell a home if there's not a home that's listed for sale. And number two, we're forecasting a slight decline because I believe that the impact of the recession is going to begin to filter through to other aspects and other segments of the economy that will begin to taper off demand a little bit. But demand is so strong, that's not going to be a big, major decline. And so I mentioned that the inventory of homes is tight. So here's the picture that shows this. We measure inventories with a number that I call months supply. And to do this, we take the number of homes that are actively listed for sale, and we divide it by the number of sales on average over the past year. So if there are 1,000 homes listed on the market right now, and on average we've been selling 200 homes a month for the past year, we would take 1,000 divided by 200, and we would say there's a 5 months supply. Now, typically, we think the housing market is balanced between supply and demand if we have between a 4 and a 6 month supply. So that's the shaded region that you see on this graph. A 4 to 6 month supply is balanced. And you can see the yellow line on there is Kansas, and we've been below as a state that bottom end of a balanced market since 2015. Salina has been even tighter than the rest of the state. incredibly tight inventories, to the point now where the month's supply is just a little over a 1 month supply, about 1.25 months supply. Those are incredibly tight levels. And what we hear reports from realtors around the state is that when homes come available on the market and they are priced right and they're in popular neighborhoods and price ranges, then we are seeing them with multiple offer situations and selling quickly. In many instances, homes are selling across the state before they're even formally posted and advertised available for sale. Matter of fact, I've always been an advocate of using a realtor as a seller because of all of the complexities in completing the real estate transaction and the value that a good realtor can bring to make sure that that contract that you get actually closes. But I've always been a little bit more ambivalent from a buyer's perspective to say, do you really need to work with a realtor as a buyer? It's like, well, you can, you don't. There's some advantages, but it's up to your personal perspective. Right now, if you're a buyer and you're trying to find homes that are available for sale, you need to be working with a realtor because, quite frankly, most of the homes that you see as they pop up on the online sites have already sold by the time they actually get posted and are live on the internet. And so having a chance to be one of those people who gets the first early look at it is really important to be working with a really good realtor. So the other piece that's been really interesting, and this is where what I've talked about the economy and the mortgage markets I think really comes to play. What I did in this slide is I took that same measure of month supply, but I segmented it by the list price of the home. And so I picked some arbitrary breakpoints. You could debate what's the low end of the market, the middle market, the upper market, but I picked 100,000, 200,000, and 300,000 as my breakpoints. And no matter what market you go in across the state, you pick cut points that are appropriate for that market, we see similar stories that are taking place. First of all, in the more modest price ranges, inventories have been tight for years. And the only impact that the pandemic had was to make that worse. As the pandemic and the shutdowns took place, we looked, because real estate was not impacted in Kansas directly. It was deemed an essential industry. Matter of fact, let me jump back one slide here real quick, because there's one other interesting thing. You'll notice on this, the blue line is the United States as a whole. And you can see that as the pandemic took root, the United States inventory spiked up, right? And that's because in many parts of the country, real estate was not deemed an essential activity. And as a result, home sales activity had to basically stop. You couldn't go out and shop for homes. Realtors weren't allowed to work. And so you ceased having more sales, and so that created that spike in inventories that's since come down as some of the rest of the country has relaxed some of those things. In Kansas, Governor Kelly made what I think was a very, very wise and thoughtful decision to say that real estate is an essential activity. It should not be shut down. And again, this reflects the nuanced thinking about how interconnected so many different aspects of the economy are. If you are somebody who needs to sell your home because you have to move for some reason, not having access to those services of a real estate agent could really be devastating to your ability, and then could have further spillover effects in so many other segments of the economy. And so we did not have those shutdowns. And as you can see, in Kansas and in Salina, we didn't see a spike of inventories as a result of that. But as I was saying here, we've had tight inventories across all of the more modest price segments for quite a while now. And the only thing that happened with the onset of the pandemic is that sellers, potential sellers, seemed to be more hesitant to put their home on the market. If I don't have to sell, do I really want to have a bunch of strangers walking through my house? Everybody was uncertain, everybody was fearful. And so potential sellers backed away from the market, whereas Buyers who were still in the market seemed to be less influenced. And so that made the inventory situation even tighter than it had been before. But the other picture on this slide I want to highlight is the yellow line at the top, homes priced above $300,000. And what you can see is that in 2018 and 19, it was really hovering at kind of the top end of a normal range. And over the course of the pandemic, we've seen that that upper end price segment has really come down where it's almost as tight as other price segments. And I think what we're seeing here, we see this across all markets in the state. And I think what we're seeing here is this is impacted by two things. Number one, the layoffs, Jeremy alluded to this a little bit, but the economic stress of this downturn has not affected all households equally. Households that are in job situations that are at the lower end of the economic spectrum, hospitality jobs and other jobs, are much more impacted than those that are, say, in information type jobs or in office jobs. If you're able to work remotely and your business is able to continue operations, he mentioned financial services industry, it's just the employment is just going nuts. Those employees have really fairly stable and safe job prospects. And so they haven't been affected. Those tend to be the ones who are more likely to be homeowners. And so where the economic stress has happened has been in segments that are less likely to be homeowners and therefore less likely to affect demand in the housing market in general. But also, it tends to be those who are interested, among homeowners, it tends to be those who are at the higher priced segments that are the most stable, the least affected by it. And when you couple that with what are, once again, historically low interest rates, every single year it seems like come in and say that, right? It's historically low. And then history is set once again. These tremendously low interest rates mean that if I'm relatively affluent and I am in a good, stable situation, yeah, there's a lot of turmoil out there, but my job is safe. All of a sudden I'm looking at those high-end homes and maybe I'm looking at a $400,000 or a $500,000 or a $700,000 home that I never thought I'd be able to afford. And with the low interest rates, I can stretch now in ways I never could. And so that's put more demand in that upper price range segment. And again, we see that in Salina, we see that in Topeka, we see it in Wichita, we see it in Kansas City. Whatever your definition of the top end of the market is, that top end of the market is no longer what we would have called a buyer's market before. It's either balanced or moved into also being a seller's market. So when you have demand that really has not tapered off much and inventories that are tight, what we've seen is an increase in home price appreciation across the state. And statewide, we've seen kind of average price appreciation on par with the U.S. as a whole, which is not typically we're below the U.S., but around 5% a year. And what's been really interesting here, the orange line on this graph are rural, what I call rural, it's not really rural, Salina is not rural, but it's a non-metropolitan area. So if you take out Kansas City, Topeka, Manhattan, Wichita, Lawrence, all of the other counties in the state, we have seen home price appreciation go from what was averaging around 2.5% a year, now up to closer to 4.5%, 5%, much stronger appreciation. And again, it's just reflecting that strong demand and tight inventories. What have we seen in Salina? I don't have a direct measure of home price appreciation that's this apples to apples comparison, but median sale price, which is the price at which half of the homes sell for a higher price, half of the homes sell for a lower price, that gives us at least some insights to it. And we can see here over the past year or so, median sale prices have gone up from around $125,000 up to about $145,000. Again, that's a healthy appreciation rate of increasing that median sale price over this period of time. So what is our forecast for home price appreciation over the coming year? We think that solid appreciation is going to continue both this year and next. 4.8% for the state as a whole this year, and followed by a 5.7% increase next year, especially being driven by the Kansas City market, where things are particularly strong. The final number that we forecast for the state is new home construction activity. And for a lot of years, as we've had these tight inventories, we've been in a place where we've said, well, you look at strong demand in the housing market, tight inventories, we should see new home construction come in to fill the gap. And for the most part, that hasn't happened across the state. And the reason is because existing home prices, for a number of years, you can't really see it here, but if you go back before the 2011, 2012, 2013, there were a number of years prior to that when existing home prices had been essentially flat. They weren't falling dramatically, but they weren't increasing either. But at the same time, construction costs continued to rise, which created this separation between existing home prices and the cost of building new homes. Well, over these years where we've seen more strong home price appreciation of existing homes, that's reduced that separation to the point where, especially at this upper middle market, say above a $300,000 price point, you really can begin to build homes now once again that are at least competitive with existing homes. And when you couple that again with those low interest rates, buyers who may have said, nah, I can't build, there's a premium for building, I'm not sure I can do that, now they're saying, well, man, if I can get a mortgage rate below 3%, why don't I go ahead and build my dream home and make it just the way I want it? People who may never have been in the new home market in the past are looking at that. And so we're forecasting fairly strong new home construction activity. It's especially driven in the Kansas City and Wichita markets, but across most of the markets other than Manhattan, we're seeing that increase throughout the state. 12.1% for this year, and then another 21.6% increase next year. So very strong construction increases. And that is the summary of my forecast. As I said, we have forecast booklets for all of the major markets across the state available on the back table there, and you're welcome to take them with you. If you're interested in Manhattan or Topeka or Wichita, you can see what we have in those markets. And once again, thanks to Credit Union of America for making these publications available. And with that, if we have time, I don't know, we have a little bit of time, I'm happy to take some questions. I see one question there.
We get into workforce for housing. It's got to be an issue here in Kansas.
Mm-hmm.
I know it is locally. What's your thoughts on?
Make sure you repeat questions for people online.
Yeah. In Kansas City, how are they overcoming? Is it just the volume, the sheer volume of the demand for houses there?
Yeah, so there were really kind of two questions that were rolled into one there. One was the general challenge of workforce housing, which is especially acute across rural areas of the state, and then whether or not there's something different that's going on in Kansas City, and I'd also say Wichita, that make that different. And so, the challenge of workforce housing ultimately comes to a supply and demand issue where the supply curve and the demand curves are not crossing. A lot of times in smaller communities, people will say, oh, we've got businesses that would love to come here because we have such affordable labor, but they are afraid they can't find workers, and then workers can't buy good quality housing at what's being paid. And you hear the dichotomy there, right? Is that in order to be able to afford, construction costs don't differ that much in Kansas City versus Salina. In some cases, Salina could be more expensive because of available supply of labor for building those homes. What's different is the cost of the underlying land, right? But at a certain point, building good new housing for workforce is a real challenge in lower cost areas because people just aren't able or willing to pay what you have to pay to build that new housing and make it affordable. So that's been an ongoing problem. It's not something that's going to go away. A couple things happen in Kansas City or in Wichita that make that different. Number one, the breadth of the housing stock. Very frequently what might be called workforce housing is often an older housing stock that may be a little bit deteriorated but still functional. And in Kansas City and Wichita, you just have thousands and thousands and thousands of those units, and as other families filter up and move into more expensive housing, that opens up what would be called workforce housing. Typically in smaller communities, even though you have some of those homes that maybe were built in the 50s or 60s or whatever, there's just not enough of them to fully make up for all of that. So I think that's part of the issue there. The other is you have higher wages in those larger communities, so that becomes part of the formula as well. Now, I did get one question earlier that wasn't related to housing. This was before the meeting started, but it was related to real estate and how, post-pandemic, we'll see businesses responding and so forth. And there were a lot of underlying trends that we'd already been seeing prior to the pandemic. One of them in retail was the move away from bricks and mortar to online activity, and that was having an impact on shopping malls and on other types of retail establishments. That obviously has just accelerated tremendous at warp speed over the course of this pandemic, and that's something that I don't think is going to change. It's going to be a real challenge. In order to really do well as a retail establishment, you have to focus on service. It's the touch points that you can provide that the online or the big box stores can't do. And I'll give an example of that I've used frequently before, which is in hardware stores, right? There was a period when we thought that the local hardware store was going to disappear because of the big box, Lowe's, Home Depot, and so forth. And that really hasn't been the case. It's impacted things, but I think where the local hardware stores that have survived have really been able to thrive has been in providing that extra level of service and being able to provide that information. And I don't know how many of you have gone into one of the big box hardware stores and said, okay, I've got this thingamajig that I pulled out and it's not fitting into my whatchamacallit, and finding that old guy who knows how to build everything that knows it. Very unlikely to find that at the big box stores. Much more likely to find somebody who's really knowledgeable about those things and direct you. Same type of issue for almost any retailer. You've got to be able to provide that level of high service in order to survive. But in the office sector, we out of time?
No. I got one quick question.
Go ahead, go with the question and then I'll come back to office.
It came from when I was talking, is by prices or by flow of real estate, have you seen people moving in Kansas from the urban areas to suburbs or urban areas to rural?
Okay.
And seen that in the price or house sales?
So the question is, are we seeing any migration patterns in housing data so far? And the short answer to that is I don't actually have data that necessarily shows those movement patterns, who's moving from where to where. But my personal belief is that people don't tend to make long-term permanent decisions based off of short-term changes in events. And my personal view is that we've had a long-term secular pattern of households moving from small rural areas to towns like Salina. People moving from towns like Salina to bigger cities like Wichita. They moved from Wichita to Kansas City, and they moved from Kansas City to Chicago and Dallas and LA. That's the trend that we see in terms of out-migration from lower density areas to higher density areas. And it has to do with availability of jobs and availability of amenities. I don't believe that fundamental fact is going to be changed by the pandemic, if all of a sudden people are wanting to go remote. We've talked about remote work opportunities as being, oh, why do people need to go live in California where it's so expensive to live when they could work remotely in some of those high-tech companies and live in Kansas and have this great lifestyle that we have. But there are amenities and there are things that people want there and that have an impact. And so I believe that's going to continue. I don't have specific data for that, but that's my belief. Let me just come back to the question about office space. The one impact that we've seen almost immediately with the pandemic is that office users had been looking at moving more and more towards shared workspace environments and using fewer square feet for their operations and for their businesses, trying to cram more people into smaller areas. And they would often couch that in terms of, oh, we're creating more opportunities for fortuitous collisions of creative activity and so forth. And some of that's true. We certainly have seen in the development side that businesses that were in process of either designing or actively building new facilities have rethought how closely, how tightly do we want our employees to be, almost immediately with the onset of this. The question is, will people continue to do the remote work and the work from home? Jeremy has said they're planning on continuing their work from home after they're done. They found it works really well. What I've heard from office users and from businesses generally, however, is that it's been a very mixed bag. The one job type that seems to have done really, really well with work from home, I've heard a lot of mortgage loan processors say they could not have gotten through all the applications they've had this summer if they'd not been able to have their employees work from home, because they seemed to be more productive and more efficient when they didn't have all the distractions of the office. But that does depend on them not having the distractions of the home. Someone who doesn't have children at home or other things becomes has some opportunities there, whereas somebody who has more distractions at home, it may be more difficult for them. On the other hand, I've heard lots and lots of businesses say that the impact of being able to build our culture, the impact of being able to have those collisions among people where new ideas, even we've all experienced it in meetings where a Zoom meeting is about to start and you're sitting here and you're waiting for everything to start. And if we were in a face-to-face meeting, we'd be sitting chatting with one another, bouncing off ideas. And sometimes really good work outcomes come out of those very informal interactions. And those are hard to replicate when we're all remote. So my expectation is that what we will see is that businesses are going to rethink some of the how tightly do we put people together, but that they are going to want to still have people together. And we could paradoxically see an increased demand for office space when we're all done, as businesses want more square feet per employees, but not fewer employees in the workplace. And now I know I'm out of time, and so I'm going to say thank you very much, and I'm happy to answer further questions later as we go forward.